Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 2, Academic Theory, Issue Number 7. A lost balloonist passes over a university and yells down for help. "Where am I?" A passing professor responds, "In a balloon." Efficient Market Hypothesis. EMH and Efficient Market Theory, EMT, suggest that the public markets are informationally efficient, such that one cannot achieve returns in excess of average on a risk-adjusted basis, given the information available at the time. EMH is the foundation of modern finance. Before you can develop a firm understanding of investing in markets, you need to remove several common misconceptions that unfortunately have become investing urban legend. The origins of EMH date back to 19th century France. EMH and random stock market prices were studied further in the early 20th century by a variety of academics. It did not reach its current mainstream form until championed by Professor Eugene Fama at the University of Chicago in the early 1960s. It remains widely accepted in the academic world, although since the 1980s it's been challenged by promoters of behavioral economics and others. EMH has been accepted in spite of empirical analysis that have consistently found material inaccuracies. In 1973, Burton Malkiel of Princeton University further popularized EMH in A Random Walk Down Wall Street. From 1977 to 2006, Malkiel served as director of Vanguard, the leading sponsor of broad market, low-cost mutual funds and exchange-traded funds. Vanguard's business model is largely built on the claim that since individuals cannot beat the market, they should invest in low-cost index funds, which Vanguard offers. At first, this may not seem in the brokerage world's best interest, but the asset allocation theories that spring forth from EMH are almost universally practiced by advisors. Ask yourself about it. Truth is that it makes their job easier. They don't need to manage investments because they don't believe anyone can win. They're also not responsible when things go wrong. There are many major conflicts of interest between clients and the commercial brokerage world that profits from EMH's preponderance. EMH requires market participants to have rational expectations, but only on average. Individuals can disagree, overreact, or be wrong. All that matters is that investor behavior is random and follows a normal distribution pattern, such that the net effect on market prices cannot be reliably exploited to make an abnormal profit. In effect, the outcome is defined in the model's required assumptions. It is not based on an analysis of empirical data, nor is it a reliable statistical predictor of market results. Strong EMH claims that the market represents all information available, private and public. No one can generate excess returns. Even when some managers beat the market, performance should conform to a random, normal distribution with a small number of lucky star performers. Strong EMH claims that prices adjust to public information, such that no excess returns can be generated by trading on that information. Neither fundamental analysis, technical analysis, nor other techniques will succeed, although illegal insider trading may. Weak EMH claims that future prices cannot be predicted by only analyzing historical prices. Share prices exhibit no serial dependencies on price patterns. Future prices are determined entirely by information not contained in past prices, and therefore must follow a random walk. Prices do not necessarily remain at equilibrium, but investors cannot systematically profit from market inefficiencies. Proponents of weak EMH usually state that technical analysis cannot succeed, but fundamental analysis may generate superior returns over the long run. Only a few of EMH failings. Empirical evidence suggests that stocks with low price-to-earnings ratios tend to have greater returns, a violation of EMH. Previously, some academics claimed that the low PE effect could be attributed to beta, another term from the capital asset pricing model, but that too was refuted empirically. Like early astronomers, academics justify each discrepancy in order to preserve their broken paradigm. Giovanni Cassini helped establish the superiority of Kepler's planetary theory, but said that only the Pope could assert whether the Sun or Earth truly moved. Behavioral economists attribute EMH's failure to cognitive bias, the capacity for human beings to act irrationally as a result of overconfidence, bias, emotions, or other errors in reasoning. They suggest that if investors acted rationally and randomly based on available information, markets would be efficient. Whether this is true or not seems irrelevant, as I feel quite confident that human beings will remain emotional for a very long time. Nobel laureate Daniel Kahneman declared his belief in EMH as follows: "They're just not going to do it, that is, beat the market. It's just not going to happen. Those that control what gets published declare it so." Unfortunately, behavioral economics has turned to serial correlations, price trends, as a potential replacement for EMH. Trending theories are the basis for technical analysis, but neglect any value of fundamental analysis. The insistence on a simple model that applies across markets ultimately relies largely on data mining, the practice of analyzing data for trends and then attempting to explain them post hoc. Others, such as MIT's Andrew Lo, focus instead on showing the internal inconsistency of EMH and its failure to explain empirical data. In 1999, Lo and Craig McKinley published A Non-Random Walk Down Wall Street. After the internet bubble and the housing bubble, few still argue credibly for market efficiency. Tragically, EMH remains the backbone of academic finance, modern portfolio theory, and the common practice of asset allocation. Few academics argue for fundamental analysis, and virtually none explain the existence of long-term successful investors. In numerous venues, Warren Buffett and his philosophical brothers have promoted value investing based on fundamental analysis. His most popular rebuttal of EMH, the super investors of Graham and Doddsville. Seth Klarman, in Margin of Safety, 1991, stated, "Buffett's argument has, never to my knowledge, been addressed by the efficient market theorists. They evidently prefer to continue in theory what was refuted in practice." The refusal to acknowledge these arguments is profound. An unidentified source claims that a 2004 search of 23,000 papers on economics revealed only 20 references to any publication by Buffett. As expected, EMH supporters dismiss Buffett's success as pure luck. In 1995, Nobel Prize winner William Sharpe called Buffett a 3 sigma event, 1 in 370. And in 1989, Michael Lewis, best-selling author and financial journalist, described Buffett as a big winner produced by a random game. By 2008, as Buffett's success continued, his performance was referred to as a 5 sigma event, 1 in 3,488,555. I expect such cognitive dissonance to continue indefinitely.